Our next guest is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Gareth has been on the show many times over the last few months to actually almost a year now. Gareth, we've been speaking, and he's made a number of important correct calls, including shorting Tesla at the right moment, calling Bitcoin to fall and retrace to $30,000, and many gold price calls that have been correct. Gareth, welcome back to the show. You have a very important message for us today about the market.
Yes.
It's about
Yes,
to
thank you
break
for
down.
having me on so quickly. I hit you up earlier today and I said, listen, there's some big stuff we need to discuss, and you got me right on, and I appreciate that. So the big news of the day is over the last couple interviews we've had, I've talked about how I do expect a market corrective move. The key was a break of a major trend line. And here, if we look at my charts, you can see that this trend line I've been watching goes all the way back to the lows from March of 2020. So that's why you know it's a major one, because this move from the pandemic panic lows has never been broken until today. And this is what I'm really watching and what I think could trigger as much as a 10% correction. And again, notice today's action on the S&P here, we're trading below this line. So assuming we don't get some sort of crazy rally into the end of the day and we close below this line, look for continued weakness over the next couple weeks. And again, it could cascade into a fast sell-off that could take us maybe as low as 3,800 on the S&P.
Okay, this 10% correction that you're referencing right now, you've talked about this several times in the show. What is a potential timeline for this correction?
Well, once the break occurs, which again potentially looks like today, I think it can happen as within a month's period. So I mean, it will be rapid. I hesitate to say 2 weeks because that's cutting myself very slim there. But I do think it's a fast one. And again, it's a technical thing. So if you think about a level breaking, like on the Bitcoin chart where I called the 30,000 collapse from 50,000, that happened within 3 days. Now I don't expect a significant 3-day 10% correction in the S&P because it's not as kind of concentrated in terms of positions, but you're definitely looking at a fast move to the downside as the algos are triggered here, the computer programs, the institutions. I'm not the only one that sees this trend line out there, and it will trigger other bigger players to sell.
Okay, so you're not, all right, I had this image in my mind of a flash crash down to 10% where the circuit breakers are triggered. That's not what you're referring to, right?
No. In general, I don't think a flash crash type event. I mean, it's always possible with the volume as low as it's been lately. It does make the market very vulnerable to a flash crash. But I would generally say you're talking about a few weeks to 2 to 4 week type period where we could find ourselves, by this time next month, down 10% at least on the S&P.
Okay, thanks for clarifying that. I feel much better now. Awesome. All right, I want to talk about the Federal Reserve because that was the big news for people following monetary policy this week. As you know, their stance is interpreted as much more hawkish than before. What was your major takeaway from watching Jerome Powell's speech and, of course, the release of the dot plots?
The two hikes. So let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. The dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots.
Yeah, so they're definitely starting to inch towards that tightening phase. As Powell said, they're talking about now officially, as the market's been wondering when that was going to happen. So I think that's key. I think the market kind of initially thought to themselves, and we saw this rally yesterday, the day afterwards, saying, okay, well, they're still talking years out. And then we had another Fed official come on today. I think it was Richard Fisher, and he basically talked about that inflation is definitely hotter than they thought. And it was the first time where the Fed kind of realized, or at least announced to the public, that they were possibly behind the curve on the inflation side. And I think that was significant, right? So if you listen to Jerome Powell the other day, he didn't really say, it's the inflation's hotter. But today we did hear that. And I think that's why the markets are freaking out just a little bit.
Just a little bit, but not a lot. We're going to be talking about the precious metals market in just a bit, but I'm looking at the stock market again now. Gareth, can you pull up an S&P 500 chart one more time? We did not see okay, that was a move, but if I were to if someone were to tell me, look, the Fed's raising rates, I would expect a bigger move downward, personally.
Mm-hmm. You're right. I mean, so just keep in mind that there's still a lot of average investor money coming into the market on a daily basis. There's this kind of thought process that every dip is a buying opportunity. So until proven otherwise, you're going to coax money into the market on these days where the market's trying to sell off, but then new money's pushing it back up. So remember, corrections, when you look at when crashes happen, in generally the big moves come at the end of a down move, not at the beginning. And the reason they don't come at the beginning is because at the beginning, everyone is still very optimistic. People are still greedy. You're still seeing the meme stocks pretty hot. So there's a lot of money that wants to be in the market and it's not scared yet. Once you get scared money later on, that's where the acceleration to the downside should come.
And you mentioned to me offline as well that trading algorithms around the world could be analyzing this chart and trading and taking action on that break in the trend line. What could they be doing, Gareth?
Yeah, so absolutely, these algos. I mean, again, institutions have great minds, even better than me, and they're very aware of this break, and they're probably in their boardrooms right now deciding, do we start to unload quicker? One of the things I pointed out to a lot of people over the last 2 to 4 weeks is that we've had multiple days where the market's open higher, and then you'll see the first hour of selling pressure. I'm trying to look on my charts to see if I can show this here. Let me see here. So you can see on the spiders, like right here, it opened higher and sold off. Over here, opens a little bit higher, sold off. Opened here, sold off. Opened over here and sold off. And to the average investor, that may not seem significant. And again, this is the 10-minute chart, so this is looking on an intraday micro basis. But what that's telling me is when you see selling from the opening print early in the day, that's institutions selling when there's volume present in the market. So an institution can unload a multi-million-dollar position over lunchtime when there's no volume in the market. They have to pick their spots so that they don't crash the market. And what we're seeing again for literally the last month is this continually happen where the markets open up, then the selling comes in, and then around lunchtime or late morning, it subsides and the markets float back up, much like yesterday. Yesterday was a great example. We floated right back up into the end of the day. That's a signal I've been noting that also tells me that there's distribution going on in the market and investors should be aware.
I'm also noticing just on that chart right there that you pulled up a lot more trading volume. Let's talk about that. What is that? Is that mostly from the short side? I would imagine.
Yeah, so I mean, every short has to have a long, so keep in mind, but basically the volume kicked up as soon as the Fed, I mean, you can see right here, this is where the Fed announcement came out on Wednesday, and look at the spike on volume and then continued yesterday, and then obviously with the drop today, a lot more participants. So it's basically telling you that there was some sort of shock to the market that triggered people to either want to buy or sell. In this case, with the markets trading lower from that point, it was a net sell.
Gareth, do you look at options at all as indicators? For example, the put-call ratio as an indicator of how bearish sentiment may be right now?
Yeah, so I absolutely do keep an eye on it. And really what you look for is when the put-call ratio gets down to below 0.5, at least historically 0.5, which means there's a really huge amount of calls versus puts, I always have looked at that as a contrarian indicator. The one thing I will say about that is it stopped working when the meme stock trade began, because what investors were doing is you saw millions and millions of small investors buying calls, and they were buying calls that were way out of the money, but it really skewed that index or that signal for me as a trading signal. So I think as a bigger macro view, yes, the put call ratio is important, but I used to follow it on an intraday basis, and you could actually short the market and go long the market based on the put call ratio. You can't do that, at least in the current period, on a micro basis.
Even for something as broad as, like, let's say the SPDR ETF?
Yeah, so believe it or not, the SPDR ETF we've seen a put call ratio overall very, very low on the SPDRs for quite some time, as the bullish bets have just been enormous in terms of buying calls.
I would imagine you're right about individual stocks like AMC and GameStop and whatnot, but on a broader market level index, that's really interesting how the entire market is being skewed by retail investors.
Yeah. I mean, they're a powerful group. They are. I mean, we've seen the types of moves they can create. And I think in the overall market, I mean, even though individually they might not have millions of dollars, combined when there's tens of millions of them, they add up to a pretty hefty institutional force.
Yeah, it's like, reminds me of Star Trek. We are the Borg. It's
yes,
collective hive of unstoppable force. They're very good, Gareth. Okay, Gareth, let's talk about your trades now specifically. Given this major news, this technical trend, how are you positioned right now?
So just like the last time we talked, I'm net short the market. I do have certain longs out there. I still continue to like, stocks like Viacom, even though that's kind of been just hovering in a range for months now. I've been a little frustrated that it hasn't gotten a better bounce, but I feel okay holding a stock like Viacom, and we can bring it up here on the chart and take a look. You can see it's down 12 cents today, but if you look at the chart here, It really hasn't done a lot, right? I mean, you had the Archegos Capital collapse and then it settled right in here. So for me, quality names are probably where you want to be, ones that pays dividends, one that have low PE multiples. I still think interest rates are eventually going to spike dramatically higher. I know people are even talking deflation again. I don't think that's going to be the outcome. So I definitely am focused on quality names, individual names, while being net short the indices.
Well, let's just talk about inflation for just a bit now. I know macro isn't something we discuss very often, but it is an important part of your trading strategy, I presume. I've heard both sides of the argument. One, that inflation is not transitory. It's going to be persistent because of monetary policy, because of a lot of other variables. And of course, the other side of the argument that inflation is going to be transitory. Prices will mean revert downwards. And what we're seeing right now is really just a base effect because prices were so low last year. It had to have risen this year, but it's only temporary. What do you think?
So I think that the spike, I mean, you've seen crazy spikes, right? So, I mean, we're not just back on commodities to levels that we saw before COVID, whether it was copper or lumber or almost any other commodity, we're sharply higher. Now, those have started to correct, which is just natural considering the insane moves that we saw. For instance, lumber, 300% move. I mean, ridiculous. But my guess is this, is you're going to see 5-6% inflation potentially in the near term. It will come back down, but I do not think it's going to come back to that goalpost for the Fed of 2%. And I think the Fed, again, based on what Bullard said this morning and even what Jerome Powell was hinting at in his conference on Wednesday, you have to think that they're starting to realize that longer term inflation may be 3%, 3.5%, maybe even 4%, which means they need to get on the ball and start tightening things. I'm surprised, honestly, they're still buying $120 billion in bonds, mortgage-backed securities. I mean, the housing market certainly doesn't need that, considering the bubble building and housing market. And they're helping that bubble. They're creating it and pushing that thing.
Well, Gareth, remember now the Federal Reserve has widened their goalpost, so to speak, by making 2% an average, not a hard target. It's like you're playing football. You're making the goalpost wider. Well, the games just become easier for you.
That's right.
So,
I mean, that's the crazy thing. If only we could all do that in our lives, is say, oh, well, let's just change the rules a little bit and let's see how it goes,
Yeah, well, you do make a good point. Okay, that's interesting how you think it's going to come back down, but not. So we're done with the 2% environment for good.
Yeah, at least for the foreseeable multi-year future. I mean, I honestly couldn't tell you where things are 10 years from now, but,
for sure.
But I'd be shocked if we get back below or at 2% in the next 3 years.
Okay. Gareth, what about, all right, let's take a look at gold and silver now, other big movers of the week. Let's pull up a chart and analyze that. I know you can't wait, you're already smiling. So gold reacted, I would say, more violently to the FOMC than stocks did.
Yes.
Tell us why.
So gold's such an interesting thing here because you saw interest rates pop initially on the Fed that caused gold to sell off. And then you saw a more sell off yesterday when interest rates fell, which is very counterintuitive to what we're used to with gold. For me, this is more of a correction from an over leveraged position. So I think the fall with the Federal Reserve comments triggered something. And then you saw deleveraging in gold yesterday, continuing that move down. Now, the beautiful thing about charts is the charts are just so simple to read here. And I want to show everyone this. You guys obviously know about Fibonacci retraces. But if you just take this low pivot down here, which was the latest move up on gold, and you start a fib and you go to the recent highs, look at the exact level we hit yesterday and are bouncing off of today. It's the 618 Fibonacci retrace. So on a technical basis, so I bought some a couple days ago. I bought more gold yesterday. I had exited gold over here when we were starting to break to the upside. And now, again, I'm starting to accumulate. So for me, this is a very simple trade, which is that gold will continue to outperform, even if it has these short-term corrections. There are buying opportunities. There's going to be a continued gold bull market. The more money that gets printed, the higher gold will ultimately go, even if interest rates do go higher.
Outperform what exactly, Gareth?
I think it has a shot to even outperform the stock market over the next 12 to 18 months. So I expect potentially negative returns in the market, while gold, I think, could be by the year end 2,100, and then by the end of maybe 2023, even 2,800 to 3,000.
And what about silver, Gareth? In a bullish environment, typically silver outperforms gold. Can you expect that to happen this time?
Yeah, so silver's a tricky one because, again, you still have kind of stuck in this range. So you have had a hit on silver the last couple of days. I would be a buyer of silver down here on the SLV just below 24, so a retrace to this trend line. What I wouldn't want to see is silver break below. So if it starts trading down to 22 or 22 and a half, that would be a concern to me. But I do think I do think silver eventually breaks out of this wedge pattern and has a significant move up. I mean, you could be looking at $40 per ounce silver in the not too distant future.
Okay, so I guess the next question depends on your timeline. So let's assume a 6 to 12 month horizon here. What would be your favorite asset class right now?
Favorite asset class? Wow, definitely gold. I'm going to stay away from Bitcoin until it corrects into that 20,000-ish range. So for those of you guys that have been following on Bitcoin, and I'm sure everyone out there is curious about that. So Bitcoin had that little breakout, short-term breakout here, and is now retracing. A lot of people are saying, hey, is it going down to 30,000 again? I want to show this trend line, folks. This is just the coolness of charts, and I love charts. But if you put a trend line and connect these highs to this high, to these highs, look at where it's retracing. So the key is, does Bitcoin hold there? I think it will, and it'll start to trade up, but eventually you will see a break lower to that 20,000 level, and that's where I'll be buying. So again, I want to say Bitcoin, but not until it gets lower. And then I think gold, and then individual names that are good quality names are places to hide in the market right now. Again, look at China stocks. I still think the Chinese market will break out in the next 3 to 6 months. So Alibaba, Baidu, Viacom trading at these levels, I think, is a quality name. Those are the places I'm hiding. And then I have a fair amount of cash on the sidelines as well that I'm looking to put into things.
Okay. Excellent. Gareth, thank you for the update today. And before you leave, we have an important announcement to make. You and I are doing a live interview, our first ever live hit, coming up in a few weeks, June 29th. That's a Tuesday, 4 p.m. Eastern Time. We'll be speaking live on YouTube. Audience participation is, of course, welcome. We will be taking your comments after a 15, 20-minute presentation like we did today, and then we'll leave the rest of the presentation open to Q&A only. Gareth, people can reach out to us directly on Twitter and submit questions ahead of time and topics that you're interested in listening to. Gareth, what is your Twitter handle?
My Twitter handle is @Gareth Soloway, so just at my first name and last name, and just definitely come check it out. And I can't wait for this. I think it's going to be a smashing success, and I hope to get a lot of great questions from the audience.
Absolutely, and mine is @David Lin _TV. Feel free to reach out to either of us. We will be taking questions in advance as well. And of course, during the presentation, we will be moderating and taking comments and questions during the event. Gareth, thank you so much for being here today. And I look forward to speaking with you live on the 29th.
Absolutely, David. Thanks for having me. Take care.
And thank you for watching. I'm David Lin.